Dayton Carr is largely regarded as, the person who started the secondary industry, but not many people know he was a venture capitalist in the 1960s, if you could believe that. So Dayton was lifelong friends with Tom Perkins and Eugene Kleiner. Matter of fact, little side note, believe it or not, Dayton was the reference letter to endorse Kleiner Perkins One, the fund that got them going. So Dayton helped get them started. What we are looking for is great growth companies trapped in older funds. That's the dynamic we're looking for.
Hey everyone, this is Prashant and I'll be host of the VC 10X podcast, and today we have Andrew Reilly with us. Andrew is a managing director at VCFA, the world's first secondary focused fund. Andrew joined VCFA in 2017 primarily to focus on origination and development of venture and growth equity secondary opportunities. In this episode, we talk about the history of VCFA and being the first secondary fund in the world, the different types of secondaries they deal in at VCFA, how they buy winners at a discount, the difference between direct secondaries versus GP-leds versus LP interests, how do they evaluate a VC portfolio for a secondary transaction, sourcing high-quality secondary deals, what is the risk-return profile of secondaries, and lots more. So without wasting any time, let's dive straight in. This episode is sponsored by my own podcasting agency called Podcast 10X, where I help venture capitalists, asset managers, allocators, and family offices in starting their own podcast and building a strong brand. Podcast 10X is designed in a way to work well with the busy schedule of investors, where we handle every aspect of podcast production so you can focus on investing. If you're looking to build a strong investor brand, starting a podcast should be right up your priority list. It's the only form of marketing where you can showcase your strong network, in other words, access to limited partners and founders, and grow that network further. And contrary to what most people hear, it's still very early to start a podcast. There are at least 10x more newsletters and 1000x more blogs than there are podcasts in this world. You can learn more about our podcasting services at podcast10x.com. I'll make sure to add the link in the description below. Enjoy this episode. Hey, Andrea, so good to have you on the VC 10X podcast. How are you doing?
Great. Thank you very much.
It's great to have you. And to start with, can we first have the history of VCFA and it being the first secondary fund that's out there?
Yeah, thanks. And Prashant, thanks so much for having me. It's been great to get to know you a little bit. But I always love sharing the history of VCFA because it really goes back to the beginnings of secondary. And a lot of people are slightly familiar with the story, but I'll give you the more detailed one. Is we were founded in 1982 by a gentleman named Dayton Carr. And Dayton Carr is largely regarded as, the person who started the secondary industry. But not many people know he was a venture capitalist in the 1960s, if you could believe that. So he was running a venture fund, started in the late 60s by he and a gentleman named Tom Watson. Tom Watson was the chairman of IBM. And we think Watson wanted a purview to what was going on in what was to become Silicon Valley. It wasn't even called that then. And so Dayton, armed with money from the Watson family and a big personality, sort of started making fast friends with what you'd think of now as the seminal names in venture capital. So Dayton was lifelong friends with Tom Perkins and Eugene Kleiner. Matter of fact, little side note, believe it or not, Dayton was the reference letter to endorse Kleiner Perkins One, the fund that got them going. So Dayton helped get them
Wow.
started. And not to go too into detail, but Rick Burns of Charles River Ventures, Sandy Robertson of Robertson Stevens, I could go on and on. Dayton was co-investing and became fast friends with those folks in the late 60s and into the late 70s. And remember, that group was private equity at the time. If you think of KKR and Apollo and all these things, they were still fundless sponsors. What this group actually invented was private equity as we know it in the 2 and 20 model. So a fee to go find deals and things on committed capital and all that. And then big buyout folks adopted that later. So if you think of private equity in the late 60s and 70s. It was venture capital. Um, anyway, fast forward to late 70s. Now, the venture fund that Dayton Carr was running for Thomas Watson is now a bit aged with still several assets left in it. Well, Watson gets tapped by Jimmy Carter to be ambassador to the Soviet Union. He goes to Dayton. He says, Dayton, I have to divest my private equity and get out of it before he goes into the State Department. So Dayton buys him out at a very good price. 4 months later, one of those remaining portfolio companies in that older venture fund sells. Dayton makes a great return and says, hey, maybe there's a business here, buying later and cheaper into the venture capital or the private equity life cycle. So Dayton, after that, started a series of small funds in the early 80s. VCFA 1 being in 1982 was the founding, and that was the first fund to prove this theory of buying later and cheaper, or buying private equity interest on a secondhand basis. And so that's how the secondary industry was born. And Dayton has not only, that in his history, but also I think he helped build the industry, because when you think of the largest players today and you go way back, Jeremy Collar was an analyst at one of VCFA's early investors, loved the business model so much. He called Dayton Carr and said, hey, Dayton, I'd love to meet with you. And Dayton kind of helped Jeremy Collar get going. They had a very good relationship. And I could go on, but what Dayton realized is, he might have been the founder of the industry, but he realized that the industry couldn't be like a one-man band. He really helped a lot of other people. And if you look at the firms and funds that have been around more than, 30 years, Dayton really probably had at one point or another helped those firms get going.
Absolutely, that's quite an interesting story. So there are different types of secondaries as well. It's great to listen to the story of how the industry was born. But now let's talk about what are the different types of secondaries that are out there, and what's the type of secondaries that you deal in at VCFA.
Yeah, so there are typically three types, although there's always emerging types of secondaries coming up. Well, there's a lot of structured transactions that are coming into the fold. But generally speaking, the most common types of secondaries today are three. There's GP-led transactions, or fund restructurings, as they used to be known as. Um, LP-led deals, those are limited partnership purchases on a secondhand basis, and directs. Directs are where you would buy a stake in a venture-backed company or PE-backed company secondhand from either an early founder, employee, or early investor. And so those are the three types. We do all three. Um, and again, given our history, we uh, uh, have kind of been doing all three of those for a long time. GP LEDs are something that is kind of new and hot in the market. Again, we've kind of been doing them since 1992. I think Dayton was kind of a pioneer on those as well. When I think the first one we know of is when we spun out Northrop Grumman Ventures. So that there was a full venture capital firm, as known these days as CVC, corporate venture capital firms in at Northrop Grumman, and Dayton bought the whole thing out and restructured the whole thing in 1992. It was a landmark deal for VCFA because the returns were so good on it. But it was also, we believe, it's hard to track these things, but we believe it was the first real GP-led transaction. So those transactions, GP-led, still tends to be what we do most of. So although they've gotten hot lately, we've been putting about 2/3 and high 60s% of our last several funds into GP LEDs. We specialize in the smaller, more complex GP-led transactions in the venture growth space. And then about 20 to 25% of what we do would be LP deals, where we're buying LP interests in funds. We tend to focus on the lesser known funds. These are good GPs, but the reason we do that is there's typically other firms and buyers and ROFRs, rights of first refusal, where someone for, let's just say a Kleiner Perkins fund, Sequoia, Mayfield, Benchmark, if you look at those real high names, someone's usually willing to pay a lot more than us for those, because they're giving a lot of price uplift to who the GP is. We're more company centric, so we tend to buy or focus on buying LP interest in what we say the lesser known but high quality venture and growth GPs. Directs are very straightforward. Whether you're any type of stakeholder in a good growth venture backed company, we'll take a look at buying, direct interests on a secondhand basis.
Absolutely, that's quite interesting. And when you're evaluating, let's say, a VC firm's portfolio for a fund, what are the key things you're looking for, and what are the key factors you look at to see if that's a good portfolio to acquire or not, right?
Yeah, so we're really looking for growth. And let me preface all of that by um, w- we call ourselves and we're known as a venture growth secondary. But I'll caveat the venture part of it, really an end of life venture investor. We don't invest in early stage, mid stage, or even anywhere near before the very late stage um, of venture capital assets. Now, we can be buying assets from an early stage venture fund, but one that's like 14 years old, where the assets themselves are what I like to call end of life venture, meaning they don't need another venture round to survive, right? They can make it to profitability, or they already are profitable. So that's one caveat. But really, what we are looking for is great growth companies trapped in older funds. That's the dynamic we're looking for. So we love to see, a company that a venture capital or growth equity firm invested in 8, 9, 10 years ago, and now is backed. Maybe they invested in the B round, and now in the F, there's even H rounds now, right? But in the later rounds, some large growth equity capital, a Cell KKR, General Atlantic, Fidelity. These are a lot of co-investors we have in the companies we buy on a secondary basis, but we got there by buying later and at a discount to maybe an Insight Partners who got in 4 months, a year ago, and we're typically trying to buy into those great growth companies, but we're buying them from an older fund and buying them at a discount to the last round. So it puts our investors in a really nice position to win.
Absolutely, that's quite an interesting approach. So you're buying great assets later and at a discount, right?
That's
So,
right.
so talking about the existing holders of those uh, that portfolio, let's say, why would they sell at a discount if it's a great asset? They can sell at whatever price it's worth today. That's one approach, or maybe try to make a profit off of that. So why would they sell at a discount to you?
Prashant, that's the question we get the most. Like honestly, when even our own investors sometimes say, "Well, who would have ever sold you, that company at that price when they knew it was going to go public?" And like, why do people do that? And so this is really the crux of VCFA and how we navigate the market and what kind of deals we look for, et cetera. And it's the secret of recognizing an opportunity and not just chasing your tail and chasing, opportunities that are never going to get closed. So we get it all the time. Why would someone have ever sold you those assets at that price? And the right answer is I don't think what we're doing is really complicated at all, but sometimes it's not obvious. And what's not obvious is really what we're doing is we're banking on an arbitrage of time. Right. So if you think of IRR, the measure of all investments, right, is your net IRR. Yeah, double my money in 3 days. Awesome. Double my money in 20 years. I probably should have stayed in the public markets. Right. So, so what we're looking to do is, get a good return for our investors in a shorter amount of time. And so when we look at investments, we're typically looking at investments that don't have that profile, that have typically been pretty long in the tooth, and where investors need liquidity. But there's a lot of opportunity out there. So how do we pick and choose the ones where we'll be able to get that question, why would anyone have sold you that great asset at that discount? That's when we know we're doing things right. And here's when you take it one step further. Well, who's selling to us? People who aren't smart? No, just the opposite. We buy from very intelligent people. And a lot of times we're not buying from an individual, we're buying from a committee. To usually, maybe there's even a consultant there doing modeling the return. And so we have to look for the very best deals among the a large amount of deal flow we get. And usually it's this. Um, so I'll use an example. Prashant, suppose you put a $10 million commitment into a fund 12 or 13 years ago. And right now you're sitting there with 1.6x your money back. So you're at least feeling this has gone okay, right? It's a venture investment. I'm at a 1.6. I hope it does a little better. And your remaining value from the last statement the GP sent you is a 0.4x RVPI, remaining value. So on paper, you have a 2x. In your pocket, you have a 1.6x, okay? But the GP is saying it's going to take 3 to 5 more years to play this out. Average life of a venture fund, 17 years, right? Sounds about right. You don't like our $2 million bid when you first see it. You're going, wait, I have 4 million of it. It's at the $2 million. But once you understand I'm underwriting to about a 2x, and that the universe of potential buyers for this probably isn't going to underwrite much less, or maybe, or could be underwriting more than that. In other words, if you're selling this to an investor, they're going to want to make some money for their investors. Okay. So we're not we're not underwriting to a 5x or this and that. We're underwriting to a reasonable PE rate of return. So we at least establish that we're not sharks and we're not bottom feeders. We're actually underwriting to that. So my $2 million bid, while it doesn't look good on your 4 million of assets, I can present to you an argument that says, right now at the 1.6 you're at, your IRR is almost 20, probably in that range, right? Net IRRs, if the investment period was drawn out, you're probably at a venture-like decent rate of return. And I can show you if it plays out 3 to 5 more years and you do achieve the 2x, you might do so at like a 13 or 14% IRR, so that you're past your max IRR. So if you're an investor and you're smart and you look at a lot of new opportunities and you need liquidity to fuel capital calls from your winning and your IRR positive investments, you as a very smart investor may realize it's better to sell at a 50% discount to me, clock your 1.8x and your 19.5 IRR rather than try to get the 2x and the 14 or 15% IRR 3 to 5 years from now. Now, we're both taking risk there, right? We both have to assess that situation. I have to assess the situation that these marks are real and I can make my 2x. They're not 2021 valuations, and I'm going to get a 1.2x. So there's risk on both sides, but two intelligent parties can model their returns and arrive at a good decision of selling good growth assets at 50% discounts in that case. So now we've been around a long time. That's what we're looking for, right? And so what we're looking for in a portfolio or someone is where 80% of that investment, like in this case, is played out. That 20% remaining RVPI can't wag the dog. Your total investment is kind of baked there. And whether I pay you 75 cents on the dollar or 50 cents on the dollar, go model that out someday. It really doesn't matter, right? So you can be a very smart seller somewhere in those ranges and take that capital and go put it in net IRR up and to the right direction investments. So that's really the key to what we do.
Yeah. Yeah, I think that's very intelligent, and I think with the very attractive market of the secondary space right now, with companies staying private for longer, it's obvious that VC funds are going to be dragged out beyond the 10-year mark, which we are already seeing, and we are also going to find a lot of good assets that are remaining in the fund even after that 10-12 year mark, and a firm like VCFA with this investment approach can benefit from that, while also the fund manager also benefits that they are able to clock those returns at that time. and which would look more attractive to their LPs for subsequent funds than
Well,
keeping
that
it there.
you
And
bring up a great point because for venture
mhm.
growth investors in the secondary space, and there's several of us. There's far more focused on the big buyout space, and that's where 90% of the deals and capital is. But for those of us focused in venture growth, one dynamic in the market has definitely served the secondary market very well, and that is companies are staying private longer because to exit both an M&A and IPO, they have to be bigger and better than they used to be. So if you look at when Apple, Amazon, et cetera, when they went public, they're pretty small companies when they went public. Look at the last several and look at the next to come. I mean, look at where Stripe is today, still private. Look at where SpaceX is, still private. Look where Uber was where it went public. It will be, that was a large IPO. It will be small compared to the larger IPOs coming. So companies are staying private longer, and that just created a much larger TAM, total addressable market, for venture and growth equity secondaries of much higher quality assets, much more visibility to the strength and direction of a company. And that's really been a great dynamic shift in venture and growth that has served secondary investors very well because now they can buy later and at a discount, but into a much larger, more predictable set of assets and companies. That's a major shift in the last decade and a half.
Yeah, absolutely. And in a previous call, you mentioned that how VCFA is more asset focused than GP focused. So would appreciate if you share more light on that.
Yeah, so there's several types of secondary firms out there, and whether you're focused on buyout or venture growth or some credit, other, um, I think there's two different ways. I generally have seen it where a lot of the people who are in secondaries um, either came from kind of a direct investing background, or came from a fund of funds world, or a fund management at an institutional side world. Those I think that's what for me explains why some people are a little bit more top down, where I say GP focused, and others are a little more bottoms up or just assets focused. Our firm, and even starting with Dayton, tended to be more entrepreneurial and venture focused. So we're definitely bottoms up. We call ourselves a deep value investor in venture. It's hard to do, but that dynamic I just described allows us to do it. We can buy at meaningful discounts, great growth companies, and that's how we do it. Whereas if you're putting lots of money to work, if you have a $20 billion fund to put to work in secondary over a 3-4 period, it's really hard to do that. You really almost need to be a little bit more tops down and trust the managers, trust their track records, and put the money to work that way. So I, I I always say there's two different strategies, and both can perform very well if you have a good secondary manager. We just tend to be the company focused, bottoms up value investor, whereas a lot of people are GP. Now, there's a few in the secondary venture growth equity. Top tier, for example, top tier is their name. They want to get their investors into the top decile GPs and make those bets. It's a great strategy, right? Those managers tend to perform well. Um, and what we are is we're a little bit different in that we're going bottoms up, and we care a little less who the GP is. Obviously, we want to invest in reputable, good GPs, but not all of those are household names like, Kleiner Perkins and Sequoia and Andreessen Horowitz. So we tend to focus on that lesser known, lesser loved by the or out of the top decile, because some of them are very good investors, and some of them even have better track records than many people think. But what we're trying to do is pick off companies. And so we look a lot more like a venture growth equity fund in terms of a team. We're speaking with C levels, CEOs, CROs, heads of sales, chief financial officers. And that's the bulk of our diligence, as opposed to sitting with GPs and going through a deep portfolio. So I think the fact that we're investing much later in the cycle and we're really trying to pick hot, great growth companies where the risk is taken out. In other words, they don't need any more venture capital to live and all that. That's just a more natural um, way to invest given our skill sets, right? So both, but you can make money in both. They're both good strategies. Ours happens to be let's pop the hood, take the engine out and the carburetor part, look at the companies. The other one would be let's just buy the best trucks we can and hope they keep running like they have historically. And so those are the two different approaches. And like I said, there's proof that both work.
Yeah, absolutely. Quite interesting. And share more on what goes on once you have, let's say, acquired a portfolio. Uh, what is inside the term, GP restructuring, fund restructuring, right? What goes on after the deal is done?
Yeah. So if it's a GP led as opposed to an LP transaction or a direct, um, they're mostly on the underwriting. It's the same thing. We're really, like I said, bottoms up looking for investment in the great companies. But post transaction, it can be a little different, right? So say we've led a GP led transaction and it's one where it's large and we may have even syndicated the transaction to some of our LPs and co-investors. We're really taking a little bit more of an active role of that GP. We're much closer touch. We would be the call it the super LP or the president of the LPAC. The way we would design a new fund is really that we have a lot of control over that new fund structure that bought the assets out of an old fund and rehired the manager to continue. So we want to make sure we have a lot of oversight and control there. So just think of that as
So
a
this,
super LP friendly structure,
yeah,
and we're kind of the lead dog LP in those.
yeah,
And
and
so
the GP remains the same still, is it?
in most cases, yes. It's
Okay.
either a subset of the GP and maybe some wanted to go do something else if it was an older fund that was, not going to raise a new fund, which we've done those deals, or it's just the GP who's, basically getting liquidity to old investors in an old fund, either all of them or a subset. And so we become on that new fund structure, we become kind of a super rights LP, if you will. And again, there's a bit of a negotiation back and forth on that. Um, but by the same token, I think we're known and we have a good reputation for being fairly passive in that we hope that we've already made the good bet, right? We've vetted that GP. A lot of the deals we do too on the GP leds, we've known this GP or we've known of these assets for a very long time, many, many years in many cases. We've just closed two GP leds where the first time we looked at the deal was over 5 years ago, right? So you get a good feel for people. There's very few larger GP led deals that we do uh, in 90 days, and it's the first time we met, and then we're closing the deal. So they have a little different, better relationship set up to them. In an LP led deal, we like to be very passive. When we say to the GPs where we are an LP, look, we want to be helpful if we can. So we're happy to help in terms of we have a very broad portfolio, as you can imagine. We do about 30 transactions per fund, but that actually means up to 40 underlying GPs. Because remember, sometimes we're buying portfolios of LP interests, sometimes we're buying larger portfolios on GP lists. So we have anywhere from 125 to 200 portfolio companies in one of our funds with a concentrated position in a little more than a quarter of those. And then a lot of other, smaller minority stakes that come as a result of LP interest and things. So what we say is, look, we open up and we say, look, we have a pretty interesting portfolio here. If we can be helpful in introductions that help your business, or please let us know. But we're not an activist, right? We really like to place our, you know, investments in the right managers at the right time, and then, you know, and then have an outcome. Now, that all being said, we do end up getting pretty involved in some of our investments, either because we need to and things aren't going exactly the way we and other co-investors want, or because we can be helpful. And we've been very helpful introducing some of our companies to either some of our investors who include CEOs of the largest airlines and the other. So we're active and passive at the same time. And where we can be helpful, I think we've got a great record of bringing real value add to some of the GPs we've invested in.
Absolutely, quite interesting. And what happens when you're hiring the same GP again to manage the fund with you? What's their incentive structure like? I believe the same 2 and 20 structure would not hold now. So what does that look
Right.
like?
Yeah. So we're big on incentives. I think there's a lot of folks out there. They tend to be more the earlier entrants into secondary. And you've probably, heard this before. I don't pay any fees. I don't pay any carry. I don't, and it's like, well, I looked into that one time. It's like, boy, wouldn't that be nice? Imagine if we were able to get away with that and say we can't pay fees or carry. And um, I, when you quickly look back at VCFA's over 4-decade history, the best performing deals we had was where there was a lot of alignment and where the GP there was highly incentivized to get us a great return. So I can only find the correlation where the incentives are good for the GP is where deals go well. Now, some of those have not gone well, but for the most part, I think the correlation is much more towards alignment than it is where there's been no fee, no carry, no incentive is where I think, there's more of a propensity to like walk away from a deal if things get hard. So we obviously don't want to pay a lot of fees and a lot of carry on a deal that might impact our investors, but we do want to be perfectly aligned. So the way we do that is we price into our price for assets is anything that we believe that price of alignment is. So now if we're doing a GP led, we're like everyone else. We like that GP to roll their carry. In other words, if the event that we're doing generates carry, we like them to reinvest that carry into the deal alongside of it. That's usually not a tough argument. Most GPs are going to do that. So then they're reinvesting their own real capital at the price we're getting in at. Okay. And then what we typically do is we like to work off something what we call an operating budget. It costs money to have Price Waterhouse, audit a fund. It costs money to have good legal representation. It costs money for good tax advice. So all that costs some money. We have a very good understanding of what that costs. We've 11 funds and 5 co-investment vehicles. I mean, we've done that a lot. So we know, and we've done it very efficiently. So we know what an operating budget of a cost. So we give a nice operating budget, which would include if they're efficient and run funds as efficiently as we know we can, there's some headroom in there for what would be left over as a fee. So if you run it or if you run it and you can keep the operating budget under where we said, and there's something there for you, but we want it to be far more about the carry. So typically what we're doing is a tiered carry. If we get a 1.5x, we'll give you a small carry, 5-7%. And if you get a 2x, which is really our mid case or rate of return, we'll give you a good 10-15% carry. And then over a 3x, we'll really give a high incentive carry. We find that really is great alignment, because a lot of times when things are going as expected, and that's like a better than 2x return for us, we find the managers who have that 3x tier or something, they're really trying to hit it. We don't want there to be such a perverse incentive that is so much better than where they are that they hold out and perhaps do foolish things trying to hit the upside. So we try to balance all those factors in every deal we do, and we price all of that into the deal in the first case. So we need a discounted transaction such that it pays for that, and that our net returns are 2 to 2.25x modeled in our mid case. So that's really how our model and how our underwriting work is. The whole cost is the cost of everything, including incentives for the GP, and do that. Now, when we're doing LP deals, it's usually just it's very easily modeled. And when we're doing direct deals, we tend to be folks that don't go into SPVs that already have fees, carry, and other language. We like to be right on the cap table, but that doesn't mean we won't. If we can price in a transaction that we think is going to absolutely, have high confidence, hit our expected rate of return, and we can bake into our price, a carry or something like that, we'll do it. So we're not we're not a no, we'll never pay fee, we'll never pay carry type of investor. Certainly, if we can bake that into our price and leave our underwriting to just what we do best is you know, buy high growth companies at good discounts closer to their exit, then we're fine.
Absolutely, that's quite an interesting approach there. And some of these secondary deals can be out in the dark, hard to find, right? So, how do you go about sourcing high quality secondary deals?
Yeah, it's I think it's a real barrier to entry. Some of the newer entrants in the market think, hey, we'll just show up with money and the deals will come. The intermediary business, short for investment banker that uh, brokers secondary deals, but the intermediaries in the space, when you start with like Evercore, who's largely known as the largest, then some of the large banks, UBS and others have secondary iBank teams or intermediary teams. Um, if you're a new entrant to the market and you just show up at all the auctions, that's a tough way to that's a tough way to be successful in secondary. I think the successful firms who have are folks that have been around a long time, or the new firms that are spin outs from people who have been in the industry a long time. And that is that I've seen that be proven out. Um, so if you take us, we're lucky. Look, we've been around. I think can honestly say we've been around longer than anyone, right? So we've been around 4+ decades. There's only firms you could count on one hand that have that going for them. And I think we all have one thing in common is that probably half of the deals we look at just come over the transom, right? So if there's a sub $40 million venture growth complex fund restructuring going on in the market and we don't see it, that would be kind of weird, right? Because all intermediaries, there was a probably no, um, David, Tom, and Drew Reilly should probably take a look at that at least, to see if there's a fit, as well as, maybe four or five others. So we're in a nice, unique position there. The other half is hard work. So the other half is we're constantly doing outbound programs. When liquidity got tight in 2023, late 22, 23, we had a hunch that corporate venture capital groups, who typically really ramp up their programs in hot venture, high growth markets, and then usually when things crash, they really all of a sudden a lot of those things they invested in strategically aren't so strategic anymore. We thought that would be a good place to go. It worked. So Andy Koch, who's a vice president on our team, led an outbound program where we're just reaching out to corporate venture capital groups saying, look, this market, has changed. We have a long history of working with corporate venture capital groups, either in restructurings or LPs or direct deal buyouts, strip buyouts. And we did quite well there. So we found a lot of very large conglomerates around the world globally who had appetite to sell their non-strategic assets at very good prices to us. So that's being creative. So at any given time, we probably have a creative outbound strategy going on. Those tend to go well to the point where by the third email group that Andy was sending out, we said, "Oh, stop! We kind of we got to work through the pipeline that just two outbound emails generated before you can do a third." So they tend, if you do them right, you have your cannons pointed in the right direction. Those outbound programs tend to go well. The other is just maintaining relationships. David, Tom, my partner, and myself have been around a long time in this industry and have a lot of different relationships. And so we just, you have to constantly stay in touch and remind people, hey, we're investing from Fund 7 now. Have dry powder if you see any interesting deals, and just constantly reminding people what our appetite is. Because people hear all the time, you know, what 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 other people's appetite is, and they, sometimes and often we get deals that we just say, look, this, thank you very much, but this is not, our fit. This is a little too earlier stage. These companies all need more capital. We know we know where you should go with this, and we'll help direct that to the right potential buyers and gain goodwill. So it's constantly work to develop and keep a very robust pipeline. And I tell our team all the time, it's our job to look at everything. It's our job to look at everything. And so, even if sometimes, you get a deal that we wouldn't do, you know how much goodwill you can gain by taking, say, a lower mid-market deal that we can't touch, but it's a seller that's desperate, needs money by Friday, and you can buy a good LP interest at this deep discount at this name. Well, that goes a long way if we pass that to one of our LPs or somewhere. So again, always listen to everything, look at the right opportunity and everything. It might not just be something we'd invest in, but it might be, passing that on to another secondary firm that's going to then think of us next time they have a deal that they know. So we're constantly being opportunistic, and to be honest with you, we're trying to be build relationships in a market that sometimes GPs are short, terse, in their own space, not very friendly. So we try to buck that trend and really try to um, gain as much goodwill as we can, no matter what the opportunity or situation is.
Yeah, absolutely. And what would be the risk return profile for secondaries?
Yeah, so that's a great question. Hard to calculate risk, I think, in private equity in general, right? Some would say if you're investing in a mega buyout fund, that's low risk. I would buy that because you're really investing in multi-billion dollar companies, and how often do those go out of business? So, but sometimes, you see they get over levered and the equity can get, crushed. So it really, sometimes there's risk where you don't perceive it. In the mid market, that is even more so true. Um, where we invest is in that growth stage where we really want to make sure our company doesn't need more capital to survive. I would say we're cutting a lot of that risk out. If you've ever seen the valley of death slide on venture capital, everyone's seen it. Company starts and then it starts burning money, and then there's the cash flow break even. Well, we invest kind of at or above that cash flow break even, but before, say buyout. And the reason I think we've taken most of the risk out there is we're usually our value drivers of the companies we're really investing in or underwriting are either profitable or a clear path, strong balance sheet, a proven technology, and are growing. The one difference people overlook there is that what your buy-in price is. And I'd like to think we even de-risk a lot further by buying in at the discounts. So if you take growth equity investors and the prices they tend to buy out, to buy into these companies at, we tend to look at that as, wow, full price. You're paying premium. You're paying, over the counter price for these companies. We like to get in cheaper, and we think that de-risks it. So we like to think, and I mean, you'd have to really start getting deep, deep, deep into math to calculate risk on this. But I kind of feel like we've moved the risk out to the right on the safety scale, more towards like later stage buyout, bigger company, by buying where growth equity investors do at a discount, because that discount is very friendly, right? So if we're buying companies that are on a high growth trajectory, we're buying at a discount closer to an exit. I think what we've done is we've underwritten the expected rate of return of venture, but we've invested our capital later and cheaper, and we've offered less, which has taken your risk down. So if you take 2008 and the global financial crisis, and venture capital, the really, along with private equity, crashed, but it was down, 20s, not quite 30%. Well, VCFA historically has invested at greater than a 40% discount. So the markets can global financial crisis again, and we're still sort of have bought in a little cheaper than the markets can come down. So when it comes to risk and reward, it's a very hard thing to actually calculate. We tend not to do it because you're never going to be accurate, and someone could always point holes because you're always having to make some assumptions. But what I think we've done with our model is by investing later into the cycle of these companies with whichever method, GP led, LP led, direct, later into that cycle where they seem to be safe and out there. Um, the key to all that, or the risk, is that we're investing when the cap tables are still long and deep, right? Buyout, if you look at buyout, most buyout or control buyout, right? Everyone wants control. So if you want to buy a great, even a growthy buyout company, you're going to talk to the GP who controls it, or maybe the GP who co-controls it with a co-investor. So you're probably not going to buy that asset at an attractive price because they won't sell it to you if they like the company. Where we're talking about, we have investors 80, 100 rows deep in a cap table, some of which got in 11 years ago at a much less valuation. So you actually have a potential seller base in a cap table that's really deep that includes people who have been in there for over a decade. Whereas in buyout, you don't have that. That's why we really, we're biased. That's a biased statement, but that's why we really love what we do, because we can buy great growth companies later, cheaper. And how can I validate that statement? Well, because all of those companies live through a seed round, A round, B round, D round, typically, not every company, but typically. So there's a good chance that someone in that cap table will sell to me at a discount because they've been in long enough. And rewind to the beginning of our conversation, probably less than 20% of their overall investment is at stake in that company or that fund. And it makes sense to sell to us at that price at that time. So that's, in a nutshell, I think we've, kind of come full circle. That's what we're looking for. And that's how we de-risk it. I can say we often we put ourselves in check every time we're in investment committee and trying to do a deal. And what we try to do is just keep it simple, because Dayton's strategy for the whole industry was buy later and cheaper, right? That's the simple premise of secondaries. That's what we're trying to do.
Yeah. Yeah, quite interesting. I love that analogy there. Horse races, third turn. Amazing. Great. So moving to the last question before we try to wrap this up. This is what's the goal with the new fund?
Yeah, so, VCA, as I said, been around a long time as a pure play venture growth secondaries investor. And that's our main flagship fund series, which is called VP, Venture Partners, Roman numeral. So we're currently investing from Venture Partners 7, and that was a $122.5 million fund that we've just recently closed. Those funds have tended to be between 125 to 250 million in size. And that strategy we're keeping right forward with. So I think we'll probably be out in the market again about a year from now, raising Fund 8. One thing, and I touched on this a little bit earlier, because we've been around a long time, we see a lot of opportunities. We are embarking on an exploratory phase of starting a real estate secondaries fund. And the reason is we kind of, to be honest with you, we've almost had enough of seeing such great opportunities in the space and passing them off to others that we said we should probably do something about this. And we see, um, very much like what we see in venture and growth opportunities, smaller, right? Smaller transactions, a little more complex. You need some understanding to do the deals. We see that a lot in PE real estate. So PE real estate is a big market, big players in it. Blackstone to AEW to Lupert Adler to, it was just a huge swath of players in that market. Um, and their investor bases today look a little unique. They have, most of those top tier players have money from all over the world, pension, sovereign wealth fund, et cetera, money that invests literally at $100 to $400 million check sizes in those firms. Then they have pages of single family offices, multifamily offices at 10 million, 5 million, 3 million, and $1 million investors. If you're in those pages of investors and it's year 10 and you want to sell a PE real estate, it's a tough thing to sell, right? So there are some great larger PE real estate secondaries groups. Jamie Sunday at Landmark, he's been around forever. You know, there's probably not too many deals of size that would ever get by Landmark. Stepstone has a group. I believe Goldman Sachs has a big group, and these are multi-billion-dollar dry powder at any given time funds. So by their nature, they can't really focus on a $1.3 million NAV or even a $5 million NAV fund that might need some work. So what we think is we think there's a good place in that market, and a couple of our peer have started to play a little bit because they have more open mandates in their funds. But I can tell you, we have several times passed off, hey, how would you like an LP interest in XYZ fund at a 65% discount to NAV? Catch is you have to close by next Friday because the seller really, needs to get rid. So we've embarked and we've gotten some, pledge capital and a long-term relationship of someone who has all the capacity to underwrite those types of transactions, and we're embarking on that. And then we also are looking at some other spaces. And so what we're doing as VCFA is we think that perhaps one of the most genius things Dayton ever did was to stay small. Right? We probably look our track record is quite good. I think at some point in the life cycle of VCFA, Dayton probably could have gone and started raising half a billion, billion, then $3 billion plus size funds. I believe that was certainly something that was a choice to either do or not do. He stayed small. I think the main reason was I don't think he ever wanted to manage a lot of people. Dayton liked having a small boutique firm and a small firm. But whatever the reason, David, Tom, and I now are here managing a smaller firm, and we love the fact that you know 90% of our deals are proprietary, and we can buy at the discounts we do. We're not showing up at best and final auctions all the time. So we think this is a great place to be. And so rather than grow, vertically and try to take our venture partners' mainstay business into the billions, we'd like to, grow that to 3, 4, or 5, maybe $600 million fund sizes over the next several funds, and then grow horizontally into other spaces where we can be the small go-to player for sellers of sub 25, $30 million, portfolios or transactions. So even though we've been around forever, we're still looking to scale and grow, but horizontally into neat new niche places where we can still be true to our smaller, lesser competitive, kind of more boutique end of the market. So that's where we're headed in the future.
Love the plans there. Awesome. I wish you all the best for that. And now let's do the rapid fire round, wherein I'll ask you 6 quick questions about the
Sure.
investing you're doing, and you have to give 6 quick answers, right? So the first one is, what are the sectors and regions you invest in?
Yeah, so we're not necessarily sector specific, and the only two things by mandate we won't invest in is legacy energy um, and real estate in our main funds. So those are the two things that are technically mandated out. Um, in the regions, we tend to be mostly North America, like 90%. That's not necessarily appetite driven, it's just market driven. If you look at the later stage, it's like I think 88% of that market is North America and a little bit of Western Europe. So that tends to be where we play, and it tends to be in our risk reward analysis on every deal we do. It tends to be there. That's not to say we do look at China LP interests. We look at some things in India. We look at that stuff, but it tends to be the deals that we close, and that tends to be, pretty much 90% a North America focus. So
What's the typical stage you come in at?
yeah, again later. So we want to know that this is end of life venture and really solid growth stage of a business. The tech's played out, doesn't need more money, and it's time to grow. And typically what we're looking for is something that's exit ready.
Mm-hmm.
It may
Okay,
not exit next year, but it's exit ready.
awesome. So you mentioned the types of deal you're doing. So you're acquiring entire portfolios, you're acquiring LP leds, and then also directs, right? That's the type of secondaries you do, right? Awesome.
Yeah, and we will lead rounds. We
Sure.
lead what I'd say syndicates more
Okay,
than
got it.
rounds. So
Yeah,
we'll lead secondary deals. That's typically either for a portfolio of LP
sure.
interest that's larger than our check size, or a
hmm
GP led where we're the lead. And typically on just about, I think, on all but one or two, and we do mostly GP led deals, we're typically the lead. Even peers in our space would a lot of times they'd rather us lead the deal and they co-invest with us. So we're typically lead on the GP leads we do.
That's awesome. What's the typical check size that you like to put in?
So if you look at our typical check size, it's typically in GP LEDs or where there's a diversified portfolio, and GP LEDs or a diversified LP portfolio, we can invest up to $15-20 million check sizes. Um, what we're always backing into is in this latest fund, say $125-ish million fund, we don't want more than $5 or $6 million, maybe top end $7 million exposure to any single asset. So if we're doing, say, a small GP led with 5 companies left in it, and there's 3 companies left, and it's a $17 million portfolio, we want to make sure that our exposure into single companies, even when we're doing a deal, it doesn't exceed that. So that's one measure. And then we will also do a $500,000 LP interest or direct deal to get a toehold when we think there's an opportunity to buy more, right? So we're really open-minded in terms of our check sizes, but opportunistic.
Sure. Where can founders, fund managers, LPs get in touch?
Oh, I think the best way is just to go directly to our website, www.vcfa.com. You can get in touch with us that way, or we're all easy to find on LinkedIn. Um, and also I'm an open uh, uh, communicator as well. So Reilly, A Reilly at VCFA.com. If you have questions, have a deal, etc., I'm easy to find. So,
Awesome. Last one. Where can our listeners follow you?
I'm not a active social media participant, um, only because I think it can be a time suck, and I don't have that much free time. So, again, the best way is probably to hit our website, and our chief admin officer in our firm, who's been with us 30 years, believe it or not, Susan Harris, Harris at VCFA.com is the best quarterback of any small firm in the world. So she can always find David or I at any time. So yeah.
That's awesome. It's been great having this conversation with you. Very insightful on the secondaries market and the unique approach you're taking to it. And right now is an amazing time to be in the space. So thank you for sharing all these insights, and I wish you happy investing.
Thanks, Prashant. It was great to be with you today.
Likewise, thank you.
Nice up.